Hey everybody, welcome back to Dividend Stockpile. So today I'm joined again by Mike Khouw from YieldMax to discuss some exciting developments, including DDDD or Quad D's first distribution and how it compares to SCHD. Plus, we're going to do a deep dive into two of the YieldMax Target 12 ETF lineup, BIGY and RNTY, and how these funds balance income with total return, where they fit into income portfolio, and what's next in the innovation on YieldMax ETFs. So Mike, welcome back to the channel.
Thanks for having me. Great to be here.
Yeah, absolutely. Thanks for coming back on. I always appreciate our conversations. You're, of course, a wealth of knowledge when it comes to these ETFs. So it's really exciting to get your perspective on some things and get some details about the products you guys have out there. I think a lot of people think of YieldMax as, some of the super high yield ETFs, but there's a lot more to what you guys have to offer, including these Target 12s and this DDDD that we're going to be talking about today. So for those who haven't heard from you, can you give a little background on YieldMax and yourself real quick?
Yep. So YieldMax, we have a wide family of options income ETFs. As you point out, we're probably best known for some of the single stock options overlay income ETFs, like MISTY, which is an options income ETF on strategy stock, MSTR. Uh, Obviously, an area of considerable interest given what's happened to the crypto space generally and MicroStrategy strategy. Bad habit. They should change their ticker to just SDR or something. Um, Specifically, obviously, we have some on NVIDIA as well. So INVIT, which is a target 25 on NVIDIA, that's probably well known. And then Chippy and Soxy, which are semiconductors. One's a target and one's just basically a more traditional YieldMax approach. When you look at the YieldMax family of products, some of them seek to maximize distributions and some look for a balance between distributions and capital appreciation. Um, for people who have an interest in a single stock, those are really targeted for those people, basically to democratize options income so that you don't have to manage rolling weekly call spreads on a single stock, which if people have a job or even just an interest in getting away from their desk from time to time, probably a little bit hard to do. But things like BIGY, which is the top 50 largest publicly traded companies, that's not an aggressive strategy. It's really more of a diversified strategy. Looks to generate about 1% per month, pays monthly distributions. So we have that. And then, of course, Quad D, which you mentioned, it's basically the constituents are the Dow Jones US 100 Dividend Index. That sort of gets people into a sense of what kind of companies we're talking about, the Kimberly-Clarks, the Procter and Gambles, those types of companies, typically lower volatility. There is another ETF that tracks those stocks called SCHD that is issued by Schwab. And our idea here was we will purchase those exact same stocks. We will pass through the dividends in the same way. So for the regular dividends that those stocks issue, which for some people are qualified and therefore have favorable tax treatment, we'll pass through the qualified dividends. But then we'll also do a very modest options income overlay to try to bump up the distribution a little bit more, because people who invest in conservative stocks are usually doing so for income and they can't take a great deal of risk. But maybe a 3%-ish dividend yield isn't quite enough. And so if we can bump that up a little bit, or in our case, our objective is to double the distributions, then that might actually suffice.
Yeah, it's great to have a variety of different solutions for different investors. To your point, some that want that super high yield, and that's the most important part of it. Others want a more balanced approach where they can get some capital appreciation as well as some moderate yield. So it's good to have a variety. Just for everyone listening, I'll run through the names of these. So we have DDDD or Quad D, the YieldMax US Stocks Target Double Distribution ETF. And we have BIGY, the YieldMax Target 12 Big 50 Option Income ETF. And then RNTY, the YieldMax Target 12 Real Estate Option Income ETF. So those are three we're going to talk about today. Last time you were on, we did kind of an overview of what DDDD is about, Quad D, and how it compares to the returns and the distributions of SCHD. But at the time when you were on, we didn't have the first distribution for Quad D. And I know that just came out yesterday. So I wanted to have you back on to kind of talk through what it looks like and how you guys were able to accomplish the double the distribution of the SCHD ETF. So can you talk about the distribution on Quad D real fast?
Yeah, sure. So one, Quad D, this is a relatively new product for us. As you point out, this is our first distribution. The distributions are quarterly. One of the questions I get about this one all the time is, why isn't it monthly? The reason is because we're targeting the distribution of SCHD, which is quarterly. We have to wait and see what their distribution is going to be before we then say, okay, that it was 25 cents, and so therefore we're going to do 50, and so on. So basically, what's going on here? We own the underlying stocks. When we first launched, when an ETF launches, give a little bit of a backstory on the mechanics of it. So obviously, you develop the structure of the product, you file. When the ETF first launches, it's typically launched with what's called a seed. So some nominal amount of capital goes in at the very beginning, and then you allocate to the respective pro rata rates of the relative securities inside of it. This is 100 stocks, as you point out. So it's a pretty big basket. And when the ETF first seeds, you cannot replicate the basket completely with that amount of capital. And the reason is because, the options, you're going to trade 100 shares worth of each. So if you put $2 million into an ETF with 100 different stocks in it, and each option has to represent at least 100 shares, it doesn't work out quite right. So there was a little bit of a transitionary period, seeded. We used some SCHD itself inside the fund. And then people who are following, because we publish our transactions every day, you can see the positions overnight as they get updated. So everybody can look at it now and they'll say, okay, what Quad D has now represents the appropriate weights in the respective stocks. Okay. So once you have all of the respective stocks from the index, the Dow Jones, a US 100 dividend index, you're going to collect the dividends, of course, from those stocks. You're going to get the capital appreciation, hopefully capital appreciation, right? We hope the stocks go up, but they don't always. But you're going to have essentially the P&L that comes from your pro rata allocation to those stocks. You'll get the dividends. And then what we do to enhance the distribution is we sell call spreads against those stocks. And, that does two things. It's going to mute the volatility very, very slightly. And I say very slightly because the target yield in this case, let's just say on a gross basis, it might be, 100 basis points a quarter of supplemental options income you're looking to generate. So, very modest. And if some of those stocks run through those call spreads, then that's going to mute the upside performance a little bit. And if some of those stocks drop, it's going to mute their downside just a little bit. But basically, it's going to behave a lot like the underlying stock portfolio. And then when the distribution time comes, we identify what the distribution amount was from the dividends. We double that amount and distribute that to shareholders. If we do our job right, hopefully we are able to time the realization of gains and losses appropriately. Qualified dividends have a tax benefit to holders. Return of capital also has a tax benefit for most investors. I mean, unless you're in an unhappy circumstance and you have losses that you're hoping to take income against rather than defer. So assuming that the portfolio managers are able to realize losses, but, basically defer the realization of gains until it's opportunistic to take them, hopefully, we'll get some return of capital. Now, I want to make this reminder. We put out the distribution. There was an estimated return of capital with that. That's just kind of, that's basically the lay of the land at the moment, right? So when people are saying, okay, at the end of the year, what's my tax situation on that portion of the distribution going to look like? Just wait until you get your 1099 DIVs, and we'll see what it all looks like.
Absolutely. And so with that distribution, it was just announced the other day on, July 1st. And you guys came out at 0.5050, so 50-50, which is exactly double what the SHD distribution was. Their most recent one back on June 24th was 25-25. And so you guys did exact double of the distribution. So you guys met the initial objective when it comes to doubling the dividend. When that gets paid, is that going to enhance the NAV of the fund if you reinvest it?
Yeah, if you take the distribution and you plow it back in, and I'm going to assume that there's a decent number of investors who, who rely on this for income. You know, the name of your channel, the name of your operation being Dividend Stockpile. It sounds to me like you're the type that has excess dividends, and you get to plow those back in and reinvest. And that's obviously the ideal circumstance when you have an excess. Some people will not have that, but if you do, if you take a distribution, it will essentially go back in. You'll have more shares, so your effective participation is going to be, the total amount, basically your existing shares plus whatever you reinvest, and it adjusts your basis a little bit in the shares. So, if all you ever did in one of these funds was just take distributions out, your basis is, especially if there is some return of capital over the course of time, your basis is going to drop. And again, how much is return of capital is a determination that's formally made at the end of the year, so we kind of have to wait for that. But yeah, I mean, if you reinvest, then essentially it would be just like if you reinvested your dividends if you owned it without the options income as well.
Yeah, definitely. And I was looking at the total return since inception, which obviously, we only have a couple months of this. I think it was March when you guys started, but you guys have tracked the SCHD returns pretty well, minus that distribution that hasn't hit yet. But once that distribution goes into the total return, you guys are going to be tracking pretty close. So you guys have, provided something very similar returns as SCHD so far, but at that double distribution. So for those who are looking for a little bit higher income, it's a really good package so far. So I think a lot of people will be happy with how it's worked out so far.
Yeah, I think an important point too is that my expectation is that it number one, it will track very closely. The other thing is that when we launched, a lot of people were asking the question. They said, well, there was a little bit of a crossover because you may remember we launched and then there was a distribution from SCHD that took place a day or two later after we launched, and people said, are we going to get that distribution? Well, of course, we hadn't had a portfolio for a month, which had been collecting dividends or collecting option income. So there's a little bit of noise that happens around, the launch of the product but over the course of time, the underlying strategy has now matched pro rata what SCHD has, what the Dow Jones US 100 Dividend Index has. And so, I'm expecting it to track quite closely. And yeah, so far so good.
Awesome.
Hopefully people like what they see and start investing in it.
Yeah, there you go. Yeah, so DDDD started on March 12th, and to your point, the distribution was announced for SCHD on March 25th. So there was only about a 2 week period. So to your point, you're not going to capture that first dividend. So that's probably where the tracking error is at this point. But to your point, over time, it should balance itself out pretty well. All right. Well, thanks for going through that overview of DDDD, the new distribution, how it's performing so far. I think that's a good follow up to our previous conversation. But for the rest of our time, I just want to highlight those two other funds we mentioned at the beginning, BIGY or BIGY and RNTY or RNTY. Can you talk through kind of what the strategy is of each of those and why it might be appealing to income investors?
Yeah, I mean, Biggie, I think this is one I mentioned. I mentioned it to you in the past. One of the probably the best proxy, I think, for most people who are interested in investing in U.S. equities generally is the S&P 500. The S&P 500 being, for the most part, the top 500 largest companies. Now, the S&P's index has some other qualifications that apply to it, and that actually becomes relevant when it comes to Biggie because Biggie is the top 50 by market cap. So there's a lot of crossover. NVIDIA is going to show up in there, Micron, Broadcom, Google, Meta, all of these names are going to show up in there. One of the distinctions, though, is that because Biggie is the top 50 by market cap, but it doesn't necessarily have all of the exact same requirements that the S&P 500 does. It can, from time to time, include a stock that does not appear in the S&P 500. Before SpaceX had its IPO, for example, that was the big question: will S&P create an exemption essentially for SpaceX, which everybody knew was going to be one of the largest companies in the world, to have it included in the index? And the answer is they decided not to. It is included in the NASDAQ. And it is actually in Biggie because we're looking at the top 50 by market cap. So whether or not it specifically applies to the S&P, we are able to include it now.
Okay, so for Biggie, you talked through some of the holdings, and obviously it's subject to change. But right now we're talking about Apple, Nvidia, Alphabet, Amazon, AMD, Meta, Broadcom, all the typical ones you think of when you're talking about the top 50. And you mentioned briefly just a second ago that you about the option strategy, but can you dig into that one a little bit more? Like, how do you guys generate that 12%?
Well, yeah, sure. So if people are looking at the positions, and you'll see a lot more positions than just the stock. So part of the returns, much of the total returns for any strategy that's like this is going to come from the stocks themselves. So the top 50 by market cap are going to track the performance of the S&P 500 pretty closely. And the reason for that is because the S&P 500 by weight, because it's cap weighted, the largest companies disproportionately represent the index. The reason people would have an interest in this is because they'd say, generally, I want my portfolio to kind of behave like the S&P 500 does.
Hmm.
But I also don't want to buy an ETF that tracks the S&P 500 and get a dividend yield that's going to be probably 1%, maybe less, actually. Let's see what SPY's is right now. So SPY's dividend yield at the moment is, I said 1%, 1.02%.
Hmm.
I'll call that close enough for government work, right?
There you go.
So if you are more interested in getting regular distributions, BIGY is looking to pay 1%, not a year, but is looking to pay 1% a month.
Yep.
Pretty big difference.
Yep.
So that's the objective. Where does that come from? There will be a small amount of dividends, and I mean really small, because we own the stocks, but you're you can't take what isn't there. So
Yep.
there's going to be a nominal amount of dividends that gets paid into the fund, and the rest is going to come from options income. How do we generate the options income? We sell upside call spreads against the stocks that we own. Critical distinction in a call spread is that when you sell an upside call spread, rather than just selling a covered call, when you get that situation where the stocks really rip like they did earlier this year, you might end up muting some of the upside participation. You're also muting a little bit of the downside participation because you're collecting some income when that happens, but you're not capping your gains. And that's a really important element. So you can go to the website, you can download the holdings. But yeah, this gives you a pretty good example. I'm going to blow this up a little bit so that we can make sure people can actually see what's happening here, because I really want this to be clear. And hopefully you can kind of see what's happening.
Yep. Looks good.
Okay. So take a look at Lilly, for example, right? So in Lilly's case, long 840 shares of Lilly, and then short 8 of the July 1200 calls. You can see the stock's 1191.74 here. Short 8 of these 1200 strike calls, and long 8 of the 1260s. Now, as you think about that for just a moment, the difference between the strike that you are long and the strike that you are short is just 5%, right? So let's just say this is not going to happen. No one's going to come in and take over Lilly at double the current share price. But let's just say, for the sake of argument, that it did happen. So somebody came in and said, we're going to buy Lilly, we're going to pay $2,300 a share for it. Well, if you were in a conventional covered call and you were long 800, in this case, 840 shares of stock, and you were short 8 contracts, therefore 800 shares worth of the 1200 strike, your gains would be capped at 1200 plus the premium you collected to be short it, which is not inconsequential, because we've got 3175 right now in terms of extrinsic premium that you're collecting between now and expiration. So that's all good. But if it really takes off, you're going to end up sacrificing all gains above that. We're
Hmm.
not doing that. So first of all, one of the things you're going to notice right away is that not every single share is actually overwritten, right? So some percentage of the stock, we just own the stock. We get the dividends on that stock. That's it. In this case, it is about 5%. So about 95% of the position has an overwrite.
Hmm.
That overwrite is not a covered call, it's a covered call spread, which, under the worst potential circumstance, is going to reduce your upside by, and it's not quite 5%, because there's actually a difference in the price. You're actually collecting money to do this. So, net, I'm going to actually call it, we'll call it $19 or so, 18 and a half bucks. So 18 and a half of the distance between the strikes 31% of the distance between the strikes is how much premium you're collecting. So really, the most this could hurt you if the stock went to the moon is about 69% of 5%. So 3.5%. That's the worst knock that the covered call spread can have if the stock goes to infinity against your long position. And then meanwhile, you're looking to do this habitually again and again and again. And then, the hope and expectation is that over the course of time, sometimes the stock will go up and you won't do as well as you would have with the equity. Sometimes the stock will not run through that strike or it'll decline, in which case you keep all of the premium. And, one of the cases where you get to, and this is an interesting thing, right? So if you are in a situation where you have to cover, and you would have to cover. So if the stock runs through the short strike, you got to cover it because you want to continue to own the stock. That's when you book and realize that loss, right? So that's how some return of capital can also creep into the equation. But you can see the stocks that are in this. I mean, these are really familiar names. We've got, some of them are, the biggest companies that are out there that everybody's aware of, like the AMDs and the Apples and things like that. Costco's obviously one of the bigger companies, and some of them are probably not the first names that come off of the tip of everybody's tongue, but are well-known businesses nevertheless. Merck is certainly an example of that. Philip Morris is an example of that. Procter, which we had mentioned before, United Health, which is a name I talk about all the time because this is a company that used to consistently trade at a premium to the market multiple and now trades at a discount because they had some fits and starts over there, but the original CEO is back. And so I think they're getting that company back on track. We're not making a judgment call on that. I mean, it's one of the largest companies in the world, so it's going to end up in here. But, just for people who are looking at it, you're going to be familiar. And then, of course, Exxon. I mean, this thing's moved around a little bit with all of the stuff that's been going on in the Gulf.
Yep, very popular names in the dividend community. I'm sure most people are familiar with a lot of these or own them personally. And having that covered call spread on there gives you that income, but also it doesn't cap your upside the same way that a traditional covered call is. So it's a good balance between getting that yield today and getting some capital appreciation potential over time. So that's why I really like this particular product, and that's why I think the Target 12s are a really good, place for people to look at if you want some additional income but don't want to take the high risk of those, super high yielding ETFs like we were mentioning towards the beginning. I appreciate you walking through all the details of Biggie. Having that cover call spread definitely makes a difference when it comes to the volatility. You still get some of that upside. We also get some of that income, which is what we're all hoping for. So I think it's a really good package. Next one I want to chat about just briefly is RNTY, your real estate target 12 option income ETF. Can you talk a little bit about the holdings in that one, and is the option strategy similar to the way you guys do Biggie?
Yeah. So the option strategy. So this was a switch that was made in virtually every YieldMax ETF. Many people think of YieldMax as a covered call fund operator. We are not. We trade principally covered call spreads, and then in some other products, whether it's Salty or Alti, we're doing something a little bit more nuanced. We have, first of all, more flexibility with respect to the strategies that we employ in those, but also we have collared equity, both long and short positions, depending on which one you're looking at. I'm sharing my screen right now. I've got RNTY up. We were looking at the Bloomberg terminal for Biggie earlier, and that didn't work, but it is working for this one. So not sure what's going on with Bloomberg today, but I believe Bloomberg is correct on this. Yes, you can see here that the strategy is basically the same. So I'm going to sort by ticker. And the reason I'm doing that is so that you can see IRT, we've got some stock, we have some short calls, we have some long calls. We're short. We have, in this case, 9,128 shares. In the IRM, you can see that we're actually short 20 of these call spreads, but we're long 2,100 shares. And this is another important thing, which is that not every single, I think this is a critical thing to remember, is that we're either going to have an overwrite. More often than not, it's going to be mostly an overwrite. But sometimes it's not going to have any bit of an overwrite, either because the options are unattractive, in some cases, if you have odd lots of stock like EQR, you can see we've got a 34 lot of the option side on this, an odd lot of 2 shares. In the case of DLR, you can see we've got 1,935 shares. We're short 19 call spreads. But you can see that the call spreads we trade in this are going to be relatively tight. We trade monthlies. These are all going to be expiring 2 weeks from tomorrow. And then we just roll and do the same thing. Now, in the real estate business, many of these are passed through entities to begin with. So they're going to be paying distributions themselves. So you're going to collect those distributions, plus have a nominal amount of additional income that's going to come from the option side. Not a super volatile basket of securities. So because they aren't really volatile underlying securities, the options premiums will ultimately end up being a little bit more modest in any case. But that's basically it. I mean, this is the strategy that we like. We try to keep it pretty simple over here. We just try to make sure that we execute to the plan and, just focus on the respective investment objectives.
Mm-hmm.
We have RNTY, Quad D for people who don't want volatile baskets of stock. We have those products for people who are looking for more modest distribution amounts. I mean, assuming that SCHD, the Dow Jones US 100 Dividend Index, and Quad D, continue as they have been, we're looking at distributions in there, high sixes, maybe might get to 7 or a little bit above, depending on how the underlying companies decide they're going to increase their dividends. Everybody can look and see what the expected dividend growth for these businesses are, and then from that, you can probably deduce effectively what the Quad D distributions are going to look like. A lot of that's going to be up to the corporate management. Some of them will raise their dividends. Some may elect not to, but it gives you a good sense of how these things work. But that's going to be a lower volatility basket. BIGY is going to be a lower volatility basket than, say, a SOXY or a Chippy will.
Mm-hmm.
But I think you get a sense of how the strategy ultimately works. RNTY is going to be the lowest of all, right?
Yeah, the real estate is typically pretty stable. Just going back to RNTY, some of the holdings right now is Welltower, Prologis, Digital Realty, Simon Property Group, Texas Pacific Land. So very stable, very well-established real estate companies. So to your point, these Target 12 and the Quad D, they're a less volatile option strategy while still providing some of the income. But it's not these extreme yields that some of these other covered call ETF strategies that are out there right now. So for those income investors who are looking for a balance between capital appreciation and a higher yield, these might be something to really look into.
So I know that people think of YieldMax as, being sort of high flying stuff, but there's a reason why people think that. That's because I think they're naturally investors are naturally attracted to the stuff that's moving around. People don't turn on CNBC every day to find, let's go watch the stocks that aren't moving and we know aren't going to move. Nobody does that because they don't move. That's by definition, you don't need to, maybe you check the paper on Sundays to see how much it's moved. That's the kind of stocks that are in RNTY. That's the kind of stocks that are in something like Quad D.
Yeah.
If you're going to Yahoo Finance every 15 minutes, you're probably looking at Micron and Broadcom and Strategy and SpaceX and stuff like that.
Yeah.
So we do have funds that contain those, but we also have funds that really don't move very much.
Awesome. Well, I really appreciate you talking through some of these ETFs today. To your point, some of the less volatile or lower volatility type of options that you guys have, but you still get some income. And so I think a lot of income investors, especially those that are focused on more traditional dividend side, will find these really appealing. So I wanted to bring you on to kind of talk through what these are all about. Let people know that there are alternatives out there that you can find the spot that fits your risk tolerance, your risk profile, your income needs, all that stuff, YieldMax, and of course other places as well. Mike, really appreciate your time. Before we end, anything else you want to share?
No, I just really appreciate you bringing me on. I mean, I don't know when you're going to actually get this video out, but for us, for you and me, it's the day before the 3-day weekend of our great nation's 250th anniversary. So I hope when everybody sees this that you enjoyed your long weekend, you enjoyed our nation's birthday. And as always, thank you very much for having me.
I really appreciate it. All right, absolutely. We'll talk soon.
Take care.
Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. Make sure you subscribe. Click the like button. It really does help. Thanks.